Today, I'm going to show you 3 UK stocks to buy in July 2021, including one that I've not mentioned on the channel ever before. And if you like the video, please try one of these to beat that YouTube algorithm. The first stock I'd like to talk about is one that I've spoken about a few times. And in fact, it's now a stock I do hold, although it's not included in my portfolio series on the channel. This is because I wasn't able to acquire it on Freetrade, and that may be a substantial hint for those keen viewers of the channel. This stock is best of the best, or BOTB. Recently, and I say recently, in the last 2 weeks, the share price has dropped by nearly 36%, and this is due to the release of their final results. Final results looked quite promising, albeit more on the negative than a promising side. They'd shown they've got good, strong growth for the full year. However, when you split it up between the halves, half one and half two, you'll deduct that half two really didn't show much financial growth from the first half, meaning revenue had only slightly increased, and same with earnings. You would imagine that a company of this size and one that has been going for a while would know how to market their business, and so this suggests that this could be a troubling factor, especially combined with what I would say is a very cryptic but very also subtle profit warning. This had said that they had experienced somewhat of a reduction in customer engagement compared to this time last year or summer 2020 as they were leaving the lockdowns, but I find this very much understandable. This is because, for one, this is very short to medium term. With online businesses, they are much more volatile, much more exposed to the cyclical trends of consumers. At the moment, the reopening of the hospitality and non-essential retail has meant that people's money, their savings that they had accrued during these lockdown periods, are likely being spent elsewhere. After all, I feel that I would know this in first-hand experience because I've both spent a lot more money on things I don't really need, but necessarily going out and having fun, I guess. And I've also seen a reduction in my own revenue from the YouTube channel. I feel that people at the moment are less interested in stocks and investing. Instead, they're sick of screens. They've been trapped in the house for a majority of the last year, and so it seems logical that people are going out more and spending money. This means a competition service like BOTB, where they do weekly competitions to win luxury cars, is going to see more of a negative impact of that. And in fact, I find it more resilient that they were able to maintain their earnings for the second half instead of seeing a somewhat of a decline. And so it will be really interesting to see how they perform in the next 6 months onwards from this point, and then see it in contrast. Because for myself, and obviously I am comparing a YouTube channel of absolutely no size or scale to a nearly £200 million market capitalization company, but I've certainly seen massive reductions in my overall income that's divided by at least 4 times. And so with a company like BOTB, if they're able to keep that constant whilst they may be experiencing more of a tougher market environment, then I think that's a very promising sign. Regardless, I think they are a very, very high quality company, and there are a few aspects of this that I really do like. Of course, they are an online competition operator, and so their moat is far from impenetrable, but they have built a loyal brand following. They'd been seen in airports for the past 20 years before closing their operations and moving to only online in the last year. They would have been known as the brand. They're more trustworthy. They've built rapport with the customer base, and so it wouldn't be as hard to obtain clientele from the start. Whereas I think other companies that try to start competition operations with a purely online standpoint, or at least more recently, they may struggle more to see adoption because obviously they're lesser known, whereas BOTB had the advantage that when they were in the airports, they were in person, they were more trustworthy. And since they've built that rapport and customer support up, I think they have that advantage compared to others in the industry. What I do find interesting is their valuation, and I'm not really one for valuations, although their price to earnings ratio is around 14 to 15 times compared to the general market, which is about 24 times at the moment, which I think is very much promising because this shows that they are significantly undervalued if they were completely fair to the market, although I feel they're a higher quality company and much better than a lot of the companies you see in the general indexes. They've had a 5-year compound annual growth rate of their earnings of 45.8%. Sustainably, this is unlikely to continue, especially because in the last year, revenue and earnings had spiked up, showing a substantial gain from the pandemic. But even in the last 5 years prior to the pandemic, they'd managed to double their revenue, or more than double their revenue in the last 5 years, combined with increasing their profit margins of 6% to over 16%, which in my opinion is a very promising sign to see. As they spend more in marketing and advertising, if their margins are still going to increase despite giving out higher rewards and reducing the price of competition entries, then it seems very interesting to see if that profit margins increase, because then whilst they're investing more in marketing, the business is still growing substantially. What I do like, as usual, is that they've got a fantastic balance sheet with £11 million of cash and no debt. This is also combined with the fact that they have a very healthy dividend, which they had increased from last year, which was 3p to 5p this year. That doesn't make sense to me, because the dividend yield would be a bit high. According to Simply Wall Street, it says the dividend is 5.51%. I'm now very doubtful of this because I've just worked that out in my head, and that's really not the case. But the interesting part of it is that they have a payout ratio of 4.1%. A 4.1% payout ratio means that they have a lot of room to grow this overall payment, especially because they don't need to invest that much in their marketing campaigns to generate customer engagement. It seems like this dividend, if all else goes wrong in terms of financial growth, could certainly be ramped up in the medium to longer term. However, management have been decreasing their stake in this business, and so some people that's a red flag. However, to me, I think this is a very good sign, because institutions have been buying up where the management have left off. This would hopefully mean that there is more liquidity in the stock, because they did have a much higher stake. They still have 49% stake of the overall company, but before it was much higher. With the institutions being there, it might add more liquidity and decrease the spread, because the spread is likely the biggest downside of this stock, because they are very much, well, a penny stock, I should say, and they are low liquidity. This means the spread, the difference between the buy and sell price, is going to be quite large, and it is a spread of 9%, meaning that when you buy in, you're going to lose 9% flat, not including fees of your broker, which obviously is a large downside, although I would justify it because I feel they have a lot more growth potential over the longer term, mainly because they've not got to worry about buildings. That's a really weak way of explaining it, but it basically means that they don't have any financial obligations and they can just scale indefinitely online, providing they are able to continue growing. And so for me, as someone who actually bought this stock about 2 weeks ago, and I'm only talking around 10 to 20 shares, I think this is a very good one to hold in a portfolio. And if you're interested in signing up to Freetrade, you can get a free share worth up to £200 when you use my link in the description down below. The next stock on the list is actually one that markets and sells spirits. You may think immediately, what about Diageo? They market and sell spirits? Well, this is not the case, because this stock I don't believe I've mentioned on the channel ever before. This company is called Distill. Distill are notably popular due to one of their spirit brands, Red Leg Spiced Rum, which had seen an increase in popularity over the last few years, whilst absolutely nowhere near as dominant as the likes of something like Diageo's offering, like Captain Morgan's Spiced Rum. There's certainly potential for this brand to pick up. They've already built up a strong rapport and customer base that this could continue growing in the future, and due to their smaller size, could actually outpace these larger brands. But I talk about these larger brands not because I think they could certainly catch up and dominate. I talk about it because I think these larger brands might be very interested in the likes of Distill, because they are a microcap. They're only valued at around £11.5 million. And this means these brands really wouldn't be investing much to potentially eliminate a strong competitor should this spirit grow in that longer term period. But also, if they were looking to diversify, and let's say a brand was looking to add another spirit to their collection, they do also have other drinks, but I would regard Distill as very much a one trick, meaning they focus a lot of their attention on that one drink. I would say that this could be a very good thing for competitors to do, and at their cheap valuation, relatively, that wouldn't cost a big conglomerate that much money. They actually have had fantastic earnings growth over the last 5 years, and you can see a very consistent trend. You can see how they've stepped out of unprofitability, because they were unprofitable years prior, at least 5-6 years back. However, now they are profitable and they are consistently going up. Although you can see it is a bit volatile. It goes up and then slopes down. This could just be general trends in the market due to the spirit sales, and perhaps the second half of the year or the first, whichever way around it is, it weakens. Or it could also just be a case of delayed reporting, and that they I don't know really what I'm talking about. And revenue since 2016 has more than tripled, so I feel there is a lot of potential with this business. Once more, they have a high quality balance sheet with absolutely zero debt and £1 million of cash, which if you remember, they're valued at £11.5 million. That is a substantial cash holding for a business of that valuation. And I think this has potential to disrupt the industry. Red Leg spiced rum at the moment is very much niche. It's likely a hidden gem. However, I feel that over the future, this brand could certainly pick up. And if they're clever enough and the management are more skilled, they may be able to use the popularity of Red Leg spiced rum and piggyback other brands, perhaps in other slight industries, in other different spirit brands, that they could push up other brands at the same time. That would be the wise move for the medium to long-term future, but ultimately a holding in this company is very speculative. This is a micro cap after all. They are profitable, don't get me wrong, but without building up a strong brand awareness and loyal customer base, this could be subject to a lot of volatility. I strongly believe that there is a lot of potential for a brand to buy this, and whilst they would have to sell over 10 million units of Red Leg spiced rum to even be on the top 10 sellers of the world, I do think there is potential. Even perhaps a bar brand could buy this up. So a pub retail chain could actually buy their own exclusive spirit brand and add to their own collection. This doesn't seem too far-fetched to me and could be imaginable in that medium to longer term future, especially as I believe some pub chains that are listed have been raising capital. They could be looking for acquisitions, even though some of them have a lot of debt too. And the other stock on the list is FDev, or Frontier Developments. This is a company I like a lot, although I don't personally invest because I hold Team 17, another video games developer in the UK. The thing with Frontier Developments is that they are very much based on one game, which is the likes of Elite Dangerous. Whilst they do development operations independently for other businesses and do have other games in their catalogue, undoubtedly Elite Dangerous is by far their most popular, and with good reason for it as well, because Elite Dangerous is an online space simulator. In fact, I would go as far to say it's an RPG, MMORPG. This is because This is because you have your own spaceships, you interact with space stations, other players or other people flying ships in that universe. You may go hunt people for bounties, you might even go trading and moving cargo, or you might be escorting passengers on a tourist trip across the galaxies. There is a lot of potential with this game, and recently they've included a new area or expansion, which means you can, not only can you land on planets, but you can get out in person and interact. I think this has a lot of potential for the future as a game, and I think they could make a lot of money off of it, even through subscription services to the game model, because relatively, for the overall game, I would find it a very cheap price. Regardless, once we get less out of what they make and more into their fundamentals, they are very promising too. Their 5-year CAGR of their earnings is 32.2%. You can look at the graph and you can see it's very volatile. I suspect this is due to when they release games. Some games likely have more of an impact than others, and so some periods of the year are going to do better. This is something I somewhat dislike, but what we can see is that it is positively uptrending despite that volatility in those financial years. And undoubtedly they have very strong profit margins, currently sitting at 22.3%. So they're able to build up a lot of cash and then potentially invest that elsewhere, which is what brings me on to the balance sheet. The balance sheet is great. They've got £35 million of cash and absolutely zero debt. This cash might be used for something. They're either going to invest in their own business, or we might see them acquiring other more smaller studios as they build up their games catalogue and library. They have the larger operations, they could buy these smaller brands, really enhance their potential, and who knows what they may release into the markets, and it might be a very popular opportunity. But also in this industry as a whole, we did see Codemasters acquired by EA, and so acquisitions in this industry could be very likely for both Team 17 and Frontier Developments, and so it would be interesting to see what may happen. What I do like as well is that insiders hold 35% of the business, which suggests a strong management, well, not really that, which suggests that they have got skin in the game, much like the BOTB, that these in the management believe that Frontier Developments will do well over the future and thus remain invested. If you're interested in my stocks to buy now in June 2020, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic day.